When the sudden threat of military action hit the world's most critical choke point, global maritime traffic essentially froze. Overnight, warnings flooded in that 20% of the global oil supply was suddenly at risk, prompting new fears of massive physical shortages. This chart tracks the market reaction. Brent crude spiked past $100, with forecasters projecting a jump to $200 if the closure lasted. But traders priced this as an on or off switch, assuming a fifth of the world's oil was instantly erased. Yet physical shipping data reveals a different reality. Instead of an absolute shutdown, logistics operators are executing a messy, partial re-engineering of how fuel actually moves. The horror scenario dominating screen prices simply does not match the volume of oil still navigating the water. Investors trading on pure headline panic are misjudging the crisis, creating a massive gap between the market's fear and the physical constraints on the ground. Iran's actual geopolitical objective is not to permanently block the strait. Instead, the goal is to weaponize the channel through selective regulation. While certain cargoes face strict restrictions or targeting from military patrols, other shipments are quietly permitted to pass through the zone under unwritten rules. The traffic profile itself has changed. The massive supertankers are staying away, replaced by a steady, patchy recovery of smaller ships and alternative regional transport vessels. This network map illustrates the choke point as a clogged artery. The flow hasn't stopped, it's moving slower and diverting into secondary pathways. Major container lines are rerouting global pathways, while the region's primary ports maintain their status as active transshipment hubs. A strategically regulated bottleneck causes severe friction, but it carries a remarkably lower risk profile than the total permanent blockade that traders initially priced in. The initial shock of the maritime bottleneck forces the supply chain to rely on an extensive overland bypass network. Recent data from Goldman Sachs proves that roughly 4.2 million barrels of Hormuz oil per day are successfully bypassing the strait through existing pipelines. Other shipments must take a secondary workaround, adding massive transit time by sailing entirely around the African continent. To blunt the immediate impact, global authorities deployed emergency safety nets, specifically a 400 million barrel reserve release orchestrated by the International Energy Agency. Simultaneously, non-Middle Eastern producers, specifically U.S. shale operations, are running at maximum capacity to offset the delayed overseas deliveries. As IEA Chief Fatih Birol warns, draining global stockpiles only treats the immediate pain. It cannot be a permanent fix for a damaged logistical artery. The global oil supply is a highly complex, flexible network that actively bends to survive localized shocks rather than shattering under the pressure. Back in the financial markets, emotional trading continues to diverge from physical data, exposing three specific blind spots. The first blind spot is overestimating supply loss. The narrative that 20% of the world's oil is permanently gone ignores that those barrels are merely delayed, diverted to new routes, or sold at a discount. This chart illustrates the second blind spot, underestimating demand destruction. When prices push into the extreme $100 to $150 range, it inherently forces a drop in global consumption. Consumers take fewer discretionary flights, and power plants aggressively switch fuel sources. That destruction in demand acts as a ceiling, actively pulling prices back down before they reach the worst-case projections. The third blind spot is ignoring policy shifts. Pricing in endless risk assumes a static political environment, dismissing the active mitigating effects of quiet diplomacy and armed naval escorts. The structural damage to global trade routes is severe, but the endless, unmitigated doom priced into the oil markets relies on flawed mathematics. Traders reacting purely to headlines will find themselves trapped by panic. Those tracking the physical re-engineering of the supply chain will see a reality that is ugly but manageable.